And let me share my screen. Just give me a minute. My part 1 book is open. Let me open the part 2. Okay. Okay. So let me quickly share my screen. I hope you guys are able to see the screen. Okay, now it's visible. Great. And those are having part 2 books. I know, like, we have not launched the new updated. I'll tell you simple story to you guys. It's been very disheartening to me that people are selling my books on Telegram. They're scanning the book and selling the book on the Telegram. I don't know. As soon as we know the name of the person, we are going to move forward with the legal action, because it's been copyrighted book, ISBN number, everything has been listed everywhere, mainly in the Indian authority. So in the Indian government authority, I'm going to post a simple post on the LinkedIn also on that. But trust me, guys, like, if I'm explaining something in the class, if you guys have attended my live classes, you might have seen if there are any small changes, it's going to get updated. Part 2, we have never come up with the updated book, because only two or three changes maximum will be there in the book. If you're attending, if you have old book, that's fine, attend this live regular. Just in 7 days your book will get updated. Okay, so in this 7 days, whatever changes you see in the book, keep your book ready along with me, and just make a changes, or you can just take a picture from the video which has been run, and make the changes later on. Only two or three changes are there. One is the average income calculation, instead of 26 million, that's 29 million. Then in retirement plan topic, the whole chart has been changed. The whole limits are been changed. Only that one page topic is there. Okay, the third small change here, you will see that trust taxes, estate taxes. Right now we completed the part 1 division class, which was also on the descendant final return, estate and trust, a gift tax return. Trust is not there in part 1. So the small limits are being changed, and because of that, we have not you know changed the whole book, but that's not going to impact your score. So please understand, and don't get confused when I'm explaining. Just straight away make the changes. Don't put it anywhere in the Zoom chat box or somewhere that the book is not updated or anything. It's a very mature thing which you guys can do. Just make a change straight away, whatever book, whatever copy you guys have. Okay. Okay, guys, so let's start. Mainly in part 2, I'm starting with the last chapter, because everyone thinks that they don't, mainly people don't have time to revise the last chapter, or they think that it's not important, they skip the topic. So just listen to it very attentively, and put any questions which you have in the chat box. Again, I'm repeating, do not mute. This is going to be there on the YouTube channel, so I don't want anyone. It's not a regular class, okay? The way we used to do in regular class, don't do that. Just put it in the chat box. My chat box is always open, so you can put the questions in there. Okay, so let's start with the okay, I'm not starting with exempt organization. Let's start with the descendants final income tax return first. Okay, so what this is related to, I know part 2 is all about your corporate tax, but there is a small specialized return topic where it will be totally out of corporate topics. Means there will be a 1040 final income tax return filing, there will be a estate tax return topic, there will be a trust tax return topic, there will be a farmer income topic. Okay, so we'll try to cover, mostly today's my target is these three topics. So let's start with the descendants final income tax return. Let's say Mr. X is going to file his tax returns, but during 2024, for your exams, 24 applies. Okay, don't get confused. I know many people might be doing self studies. They might start googling out the limits. They might have seen the limits. Like, don't get confused. Always use the word for your exam, 2024 tax law. Okay. So let's say Mr. X died in year 2024, somewhere on 30th of June, and we need to file a final tax return to close his return with the IRS. You have to inform to IRS that this person is dead, and now we are filing his final tax return. What will be the due date of the final tax return? You need to check in which year, in which tax year the person died. The person died in 2024. So for tax year 2024, what will be the deadline to file the tax return? It will be 15th April 25. Okay. So the due date will always be 15th April, but be careful when the person died. So just a small timeline. I know this topic is done in the part 1 just 1 hour ago, but yeah, just giving you a quick overview. When a person dies somewhere between Jan to December 2024, we file the final tax return on 15th April 2025. Okay. What if the person died after December, but before filing the tax return? In the middle of tax season, the person died, right? So what will happen? In 2024, the person was fully alive. In whole year, the person was alive, right? So whatever return you're going to file on 15th April 25, it will not be a final return. It will be the original return. Okay. But let's take an example. The person died in February 25. Okay. So for 2025, you will file a final return. What is the tax year? 2025. When you're going to file a return for 2025 tax year? In 2026. 15th April 26. This will be your date of filing your final tax return. Okay. So just in part 1 session, we completed with the estate tax return. I'm not right now straight away jumping on estate return, but I'll start with the trust tax return first. Okay. But don't worry, it will be in the flow, in the sequential format only. So the due date of filing that return will be 15th April. Now, that's what I said. If the death is being taken place between the tax season, between, like, let's say Jan to 15th April, then your due date will be for final return will be next year, that is 2026, not 2025. Okay. So please remember this simple rule for filing your final tax return. They will always ask something related to this, and just draw a timeline and remember it. Okay. So if the descendant is married at the time of death, the descendant and surviving spouse are considered married for the whole year. So this is mandatory while filing a tax return, to check the marital status of a person, to understand why whether we are filing MFJ or MFS, or as a single or HOH or whatever. Okay. So if the descendant, the person who died, is a married, okay, they need to file as an MFJ before, like, the final return. When you're going to file a final return, it should be MFJ only, but the date of death should be mentioned. We are not going to file a final return for the spouse. Okay. But it will be considered, they both will be considered as a married during the whole year. Okay. Now, what incomes they should include? This is important. What incomes they should include? You need to check whether they are following a cash method or whether they are following accrual method. Cash method is simple, right? As in, when you receive the cash, at that point of time, you will report it in your tax return. You will pay the tax at that point of time. So anything which you receive after the end of tax year, you will not report it in your current tax return. It will be reported in next tax return. So the smallest example is the dividend. Okay. So let's say the dividend is declared on November 1st, but the person died on 2nd November. As soon as the dividend is declared, very next day the person died. Okay. Now the dividend is paid on 1st December. When you're going to file the final tax return for this person on cash method, this dividend will not form a part of 1040 final return because it will be considered in the estate tax return. Okay, so let me just give you a small overview. When a person died on 30th June 2024, for example, now what date we took 2nd November. Okay, from Jan 24 till 2nd November 2024, the person was alive, right? The time when the person was alive, for this period you have to report all his income generated between this period in the final tax return. The day on which he died, after that still he might be receiving some income. Let's say this dividend income is received on 1st December, so from 2nd November till 31st December, whatever income he's going to generate will get reported on estate tax return. Okay, so just for this bifurcation you should remember, if a person is going to use a cash method, the declaration date is not important. The day on which you receive the dividend is important. Let's say between declaration date and receipt date the person dies, it should not be considered in final return because it should be a part of your estate return. It is also called as IRD, income in respect of descendant. I'll explain this terminology in a while. But let's say the person is going to follow accrual method. Okay, accrual means as soon as the income is accrued, even though it's not received. Let's say the person is having a lot of rental properties, and every first of the month the rent is paid by all the tenants, but few tenants have not paid yet the rent. Still this rent is accrued, the income is accrued, he needs to report it. And let's say they are going to pay it later on in after the year end. Okay, but can I say the rent is accrued, it is been collected after the year end, still this rental income needs to be considered in the final tax return. Okay, so just it's very simple. Report income when earned income items accrue before the death and include it in the final return. So instead of year end criteria, just remember the person was required to collect the rent on 1st December. Now the person died on 5th December. Now the tenants are paying the rent on 10th December. If the filing is done using accrual method in tax return, you have to mention it whether you're using cash method for reporting your income or accrual method. If you're using accrual method, then on 1st December it's like before the date of death, it needs to be accrued, it needs to be a part of your final tax return. Okay, but final tax means the descendants final return. Okay, person died on 2nd November, so his 1040 final return will be filed on 15th April 2025. Yes, correct. There was a question in the chat box, so I'm just answering that question. Yes, that is the correct one. Now let's say the person is still following cash method. Okay, the rent is accrued on 1st, person died on 5th December, but the rent is collected after the date of death. So when it is collected after the date of death, and if a person is following cash method, then this will form a part of your estate tax return, not your final tax return. Final tax return, you have to report everything which you have collected till 5th December. The rent is accrued but not collected, so it should not form a part of your final tax return. It will form part of your estate tax return. Okay, so please remember this. It's a very simple rule. Till the time the person is alive, we file the final tax return. After that, still your assets are generating some revenue income, you need to report it in the estate. Now estate return needs to be filed from the 9 month from the date of death. Okay, now 9 months are also elapsed, still your estate is not resolved, it's not distributed to beneficiaries, still it's generating rental revenue, you need to constantly file 1041 return every year. Okay, so those who have already completed part 1, you might have remember, you should have done this topic already in part 1. Those who have not completed, just go through the day 1 part 1 video we have completed recently, only few hours ago. Okay, so yes, that's fine. Next is income in respect of descendant. What does that mean? When a person dies, still his estate is generating some revenue, those income is considered as a income of the descendant. So it's a very simple word, income in respect of descendant. But who are going to pay the tax on that income, right? That bifurcation depends on whether you are showing it on estate return, whether you are going to show it on your trust return, 1041 return. Okay, estate return needs to be filed within 9 months from the date of death. So within that 9 months, if you're still generating revenues, yes, you have to show that income which was earned by the descendant after the date of death. After the date of death, whatever income is generated from the assets of the descendant is called as a income in respect of descendant, IRD. Okay, so if it's a capital asset, let's say if it's a building, land, stock, any asset which is considered as a capital asset, they are going to receive a step up basis. Step up basis means what? Let's say the person might have bought the property for 10,000. After 5 years, the person died, and now after 5 years, the value of this property is $100,000. So it will receive a step up of how much? 90,000. Means the cost minus the fair market value. This value, $90,000, is considered as your step up, and this you need to report it on your estate tax return. Okay, got it, guys? Next is other assets. Let's say the person might be having his traditional IRA account, or some small assets which are not actually the capital assets, some small income generating assets. Let's say a fixed deposit is there, on that he's earning a passive income, some bank balance, on that he's earning some interest income, passive income. That will get transferred straight away to the beneficiaries without any step up basis. You don't have to calculate the fair market value of the traditional IRA. Okay, when you are going to do the traditional IRA topic, or those you have done in part 1, there you will understand that when you're transferring your traditional IRA to spouse, sorry, when a person dies, only the transfer is allowed in the name of spouse. Rest all beneficiaries, anyone, let's say this taxpayer's son is there, or daughter, or any other relative family members, they cannot get the traditional IRA converted in their name. They have to withdraw the amount, they have to pay certain taxes, and then they can consider in their own name, they can deposit it in their own traditional IRA. But only one person is there, she can convert, the spouse, he or she can convert the whole traditional IRA account in their own name. Okay, so any other asset, they don't receive step up. Simple rule is, if it's a capital asset like land, land, building, stock, securities, share securities, those value will receive a step up basis. Step up is simple, whatever is the cost minus fair market value, that's considered as a increase in the, it's an appreciation in the value, that's a step up basis. Means when you file an estate tax return, you have to mention it in the estate tax return at the FMV, sorry, not at 90,000, FMV will be reported. Okay, got it, guys? Next is beneficiary are responsible for paying the tax on income from these assets. So whoever are the beneficiary, they are going to receive this at some point of time when the executor is going to distribute this estate, right? So they are responsible for paying the tax on this assets. So when you will see any estate tax return, estate tax return is fine. That's a one-time tax return. It's not a pass-through tax return. One-time tax is paid by the executor, and then still the assets are not distributed. It get transferred to a trust. We'll understand two types of trust are there. So in this trust, when all the beneficiaries are there, they all will receive a K1 from the trust. So 1041 K1 for Mr. A, Mr. B, Mr. C, like that. And whatever trust is generating revenue, okay, trust is going to prepare their own profit and loss account. The trust is going to have, let's say the person who died was having a lot of rental income. Okay, everything got transferred to a trust, because when the all the assets are distributed, then the trust get dissolved finally. Okay, until and unless the assets are not distributed to the beneficiaries, it's still standing in the name of the trust. Okay, and this trust will have to file the tax return to report the income on that real estate, rental real property, to the IRS. Who will pay the taxes? This is again a pass through return. The trust is not going to pay the taxes. Their K1 will be generated. It's just like your S corp and partnership. Your K1s will be generated, and they are going to these three people are going to pay the taxes. Yes, FMV is a step up basis. This is the basis, this is the cost basis, this is the step up basis. Step up means it has been stepped up, it has been increased by 90,000. So the fair market value, we are like, it's not, we are not increasing by a random amount. The valuer is going to give a valuation report. What is the value of the estate which is in existence? And the difference between these two is called as a step up amount, but this is called as a step up basis. FMV is your step up basis. Okay. Yes. Now what I was explaining is, yes, so this three people who is going to receive a K1, they are going to be responsible for this. When do we file the trust and estate? Okay, estate is simple. Estate you have to file within 9 months from the date of death. But the trust return, you need to file the trust return on 15th April. Whatever date the trust is formed, let's say the trust will be formed at any point of time. It's not like there's not fixed period, like from in January only you have to form a trust. As soon as your estate tax return has been filed, very next day you have to convert everything into a trust if your assets are not yet distributed. So for trust tax return, the deadline is same as individuals, that is 15th April. But estate is within 9 months from the date of death. Okay. So IRD is something like if a person dies, after that still his assets are generating income. So that income is of the beneficiaries. Okay. So that income is considered as income in respect of descendant. It includes what? Descendants estate. Deceased person's estate, sorry, not descendants, is like, the the person whose family member are there, but deceased person's estate, if the estate receives it. Okay, so they are giving a bifurcation in whose return the IRD income should be included. I hope you understand what is IRD. In whose return it should be included. It should be either included in estate return, it should either be included in the beneficiary's 1040 return directly. If before filing that 1040 return, the estate has distributed that income straight away to the beneficiary, or straight away the beneficiary has collected that income from the estate, so he will have to mention it in the 1040 return that he has received a IRD income in respect of descendant, or any third party who is receiving the IRD income in his or her return. You have to mention that particular income. It will be there somewhere on the schedule one in respect income in respect of descendant. There's a separate line item over there in 1040. Okay, so from practical perspective, sorry, from part 2 perspective, just remember that in case of a in case of a descendant income tax return topic, what are the deadlines? This is important. How you are going to calculate, whether they are using cash method or accrual method, whether mainly you have to remember the example of dividend declaration, okay? Because when the dividend is declared, the dividend is paid, somewhere in the middle the person died, okay? Then you need to check the person is using cash method for filing the tax return. This is not for accounting method, okay? For filing the tax return also we have cash method and accrual method. Accordingly, you'll take a decision and include it either in the 1040 final return or estate return, depending on the date of death falls between the dates, okay? Next is yes, now the person died and his executor, whoever is going to execute the whole estate, means is going to distribute all the assets to the beneficiaries, they will have to file a 706 form with the IRS, okay? And in that, all the gross income which is being generated from the asset will be included in that estate tax return. All the gross income from the date of death till 9 month, next 9 month, you have 9 months to file the return, right? So between that, you might have generated, the estate might have generated a lot of gross income, right? So that is called as a IRD. That income is called as income in respect of deceased person. So that needs to be included in your estate tax return as a gross income, okay? And on that, you can claim a deduction from that gross income. You can claim a deduction for any estate taxes which is paid on this income, because when you're going to file your estate tax return, you might have already paid some of your estate taxes, okay? So you can take that deduction. Even if before distributing this income to the beneficiaries, the estate has already paid the tax on this income, the beneficiaries are not going to pay again the tax on it. It will be considered as an exempt if it's already been paid by the estate. So please don't get confused. Mainly, this is not from the exam perspective. From the practical perspective, you should remember that, okay? No double taxation should be there. Once the tax is paid by the estate, no need to pay it by the beneficiary. Or let's say estate is not paying the tax, the beneficiary is going to pay the tax on that, okay, at the time of distribution. Sometimes it happens even before 9 months, even before filing the tax return, the income is distributed, right? So what will happen in that situation? At the time of distribution, whoever is going to receive that distribution, they have to pay that estate tax on that particular amount, okay? So when the estate return is filed, whatever amount is distributed will get excluded. You have to report it, but it's not liable for the one-time tax, estate taxes, okay? Can we say, okay, there's one question in the chat box. Can we say that estate return is just informational to disclose? No, no, no. It's not informational. It is filed and there is a payment of tax. So it is not informational return. Okay. 1041, the trust return is informational return because there will be a K1 in that. It's a pass through, it will be passed through to the beneficiaries. So 706 is not an informational return. Okay. There can be an MCQ on that. Medical expense deduction will be allowed if a person, okay, so there can be a question on this. So let's say if paid, whatever medical expenses are incurred. So let's say the person was very ill and he might have accumulated a lot of medical expense just before his death. Still some medical expenses are unpaid. So if paid before death, whatever expenses are there, those expenses, medical expenses, are already paid before death, then it's fine. It's a simple rule. All expenses, medical expenses, are deductible on final tax return. Final tax return is your simple 1040 return with all the Schedule A deduction, all your standard deduction, everything is as it is. Just the thing is, you have to mention the date of death on the return, and there will be one check mark box where you will select it as a final tax return. Else, the whole return is same as a 1040, and all income which you will report on that 1040 final return will be up to the date of death, because after the date of death, everything will go on your estate tax return. Okay, so see, here what they are saying: if medical expenses are paid before the date of death, that's fine. No need to worry about it. Just take it as a normal Schedule A deduction. If it is not paid before the date of death, it will become the liability in your estate tax return, because after the date of death means it goes to the estate tax return, and that expenses will be allowed as a deduction on the estate tax return. It will appear on form 706. There is a simple rule. I don't know why this marking is there. Okay, so there is a simple rule: from the date of death, if it is paid within 1 year from the date of death, then you can claim it. You can still claim it on final tax return. But if it's not paid within 1 year, if estate is paying that medical expense within 1 year, then it's good. You can claim it on final tax return. But if it's not paid within 1 year, then executor may elect to treat all the part of the expense as paid by the descendant. Means, sorry, not descendant, paid by the estate. Okay, so just understand, the rule is very simple. Up to the date of death, everything goes to the final, and if the medical expenses are paid, take it on the final tax return on the Schedule A. Medical expenses are not paid, it's okay. If it is paid, they have given a time limit of 1 year from the date of death. If it is paid within next 1 year from the date of death, yes, it is allowed on final return. If it's not paid within 1 year from the date of death, what you are going to do is, you are going to consider it on the estate tax return as a deduction from your gross estate. Okay, got it, guys? So this is one of the small rule. Like, mainly in part 2 exams, they will focus on this one line question on this. Okay, loss deductions. So loss, mainly, let's say there are some NOL loss, net operating losses. There are some capital losses. Okay, if it is being carried forward from prior years, there are some business losses. Let's say there are losses from a partnership firm. There is a loss from the S corp or C, not C corp, S corporation, or a partnership firm, which is being transferred to your 1040 return. Okay, so what will happen? Deductible only to the in the final return, not deductible. It's not deductible to estate. In, you cannot carry forward that unclaimed losses in the estate tax return. So full and final settlement, you cannot get refund on the losses. Okay, so please try to understand that full and final settlement will be done on the final tax return. You cannot carry the remaining unclaimed losses in the beneficiary to the beneficiaries or to the estate return. Okay, it's a very simple rule. You can just remember, you cannot take refund. Okay, they can ask you simple question and people get confused. Okay, if the person is going to pay, have still excess losses, there will be no refund. It will not get transferred to the estate tax return. Okay, credits are same, like all the credits which applies to the normal tax return, your child tax credit, your education credit, everything will apply to the final tax return. Okay, because just understand the concept. Final tax return is what? When from January till the person is alive, till the date the person is alive, for this period we are filing the final tax return. The person was alive, the person was having some income, the person might have paid some education expense, person might have paid some child care, everything is allowed. So in case of credits, mainly for final tax return, it will remain same as we have done in the original tax return. Okay, clear, guys? So whatever questions you guys have, post it on the this Zoom chat box. We will move to the next topic, that is estate tax return. Okay, so from in part 1 also you have estate tax topic, in part 2 also you have estate. But from exam perspective, both are totally, like not totally, a little bit different. In part one, they have very limited scope for exams, but in part two, they expect you should understand and remember most of the part of the estate income tax. So in part two, it is important, most important. Okay. So when a person dies, whatever is the probate proceeding that will open depending on the state law. Every state have a different law, which you don't have to remember for exams. You can research on your own later on for whatever state you want to understand what are the estate tax laws. So within 30 to 90 days, between this time frame, they have to appoint some executor or some representative who will take care of all the estate. Okay. First action, the beneficiaries first action from the mutual consent or whatever, that they will arrange a meeting and all, they will attend, sorry, they will appoint someone as a representative from the date of death. 30 to 90 days they have. Let's say they are not able to decide who will be the representative, they are not in good terms, or they don't have any executor. Anyone who is in the possession of the property will be considered as the executor of that property. Let's say I'm living in a rented apartment right now. The owner of this apartment died, and the state has mentioned that like there's no executor available. I will be considered as the person who is in the possession of the property. I will be considered as a responsible person. The primary duty for from my side is to report everything related to this property to the IRS. Okay, just a weird example I have given. It's a not about like the tenant is responsible to inform that all. Okay. Anyone who wants the notes or anything, just connect with Sandeep. His number is already there on the brochure from where you got the Zoom ID and passcode. Connect with him. Those who don't have books, you can get it from there. Make sure you get it from us only. Okay. I don't want to repeat again like whatever I mentioned in the starting of the class, but yes, make sure you get the physical copy, because the we don't sell any soft copy, or we don't sell any PDF copies or anything. Okay. So just understand this. Primary duties of a personal representative is like this. What I was explaining is, if no executor is appointed, no administrator is appointed, there was a small basic question on this: who will be considered as a representative? Is a person, anyone who is in the possession of the property. Let's say the spouse is currently living in a house, in a huge apartment. It's a very luxurious apartment. The fair market value is somewhere around 5 million, $6 million. Okay, and no executor is yet appointed. 30 to 60 days. First, the state laws will start giving some hints, some notices, like someone should be appointed as a representative and all. After 90 days, whoever is in the possession, she will be responsible to represent these three things. She needs to first of all apply for EIN number for the estate, because when you file estate tax return, you have to mention, you cannot mention the SSN of that the deceased person. Okay, you have to take a EIN number for that estate. You need to file a tax return when it is due, which is 9 months. We'll see further. Okay, you have to pay the tax determined up to the date of discharge from the duties. So let's say you didn't find any representative, you will be responsible, whoever is in possession will be responsible to do this 3 4 things. Okay. Next is filing requirement. Personal return, that is the final descendant income tax return, will be filed by the beneficiaries. Estate tax return will be filed by the executor. What is estate tax return? Tax on transfer asset. So whatever is the cost value of the asset, it will get transferred to estate. But at what rate? FMV. Now this FMV will be considered in the calculation of gross estate. From that, you will take few deductions. Like let's say you paid some medical expense, it is deductible for estate, then you can take some deduction over here. let's say you have paid some, the person who died has, signed for, in his will he has already mentioned that I want to pay some charitable donation. So you can reduce that amount only if it is written in the will. There was one small question I remember, someone mentioned that if the gross estate, sorry, if in will the charitable donation is not mentioned but the executor is donating from his own will, is it allowed as a deduction? No, it's not allowed from the gross estate as a deduction. Okay. Now you have to file the income tax return 1041, that is trust, if your assets are still generating the revenue of over and above $600. If non-resident, there's no limit. If you're non-resident, even if your assets are not generating any revenue, even if there is a loss, still you have to file a 1041 return if the beneficiaries are non-resident. Okay. Next is for 2024, this is not, you don't need to mug up these things. Okay. But how the estate tax calculation will happen, if your taxable income for estate, whatever revenue has been generated, okay, it can be from your rental property, from business, the total revenue whatever you are generating, if it's reported in your estate, if it's within 3100 limit, 10% taxes will apply. And there are some slab rates which are given, which change every year, which used to change every year. And for exam perspective, they will never ask the calculation part for, calculating the taxes. So no need to worry, no need to mug up the limits. Wherever it's important, I'll inform. No need to mug up these limits. Okay, it's just a tax calculation. It's just a slab rate calculation. Okay. Next is exemptions and deductions on Form 1041. So what exactly is 1041? 1041 is your trust return. So first let me explain that. Okay. So it's a trust return. So trust can be, in the two form. One type of trust is inter vivos trust. Means the person is still alive, but he wants to, secure his property for his grandson, granddaughter, and he's transferring the property to a trust. Still, the person is alive while the property is going to generate some revenue that needs to be reported on 1041 return. But that kind of trust is called as a inter vivos trust, living trust. The trust which we talked few minutes ago was the testamentary trust. Means it is created at the death by the instructor in the descendants will. So when a person died, just before that he might have already written his will, right? So when the person dies, in that will, whatever steps are mentioned by him, according to that the trust will be created, and whatever percentages are mentioned, the beneficiary's name will be mentioned. Accordingly, it will get allocated to those beneficiaries. Okay, got it, guys? So trust that takes effect during the lifetime of the grantor is your living trust. Testamentary trust is something when a person dies, it will automatically get created. They have no options. After filing estate tax return, you have to report it in trust, and that's called as a testamentary trust. Okay, so trust is a kind of a legal agreement where one party, that's a trustee, manages the property for the benefit of the another party. Okay, and it's been governed by the federal law, not by the state law. State law only governs the estate taxes. Different states have different estate taxes. Okay, but trust is a kind of a federal law, central law. Okay, next is, yes, so primary parties to the trust. Okay, primary parties to the trust, who will be the primary party? Grantor, beneficiary, trustee. Grantor means person who is going to create a trust. In case of a living trust, there always be a grantor. In case of a testamentary trust, there won't be a grantor. Okay, so the person who creates and continues the property, contributes the property to the trust, is called as a grantor. Beneficiary means who are going to receive the benefit from that property. Trustee means fiduciary, responsible for assets. Trustee means who's taking care of that whole asset. Okay, because the owner of a $5 million property is not going to leave his all work and start managing the property. He's going to appoint some representative. He's going to appoint a trustee to manage the whole property, the income, the distributions, filing tax return, everything will be taken care by the trustee. Okay. Trustee is also responsible for the payment of the trust tax, accounting, and asset and distribution. As I mentioned, he's going to take care of everything. Okay. Now, this is important for part two. Property owned by trust is called as a corpus, or we can also use the word principal. Now, three types of trust will be categorized for trust tax calculation. One is grantor trust, second is simple trust, and third is complex trust. So simple and complex, on this there is some calculation part. Grantor trust is very simple. Grantor means a person is still alive. Okay, do you remember the person is still alive now? He's transferring his asset to the trust, and then the asset is generating revenue, and that revenue is distributed to the beneficiary. So the person is still alive. He is still retaining the control of or has interest as a beneficiary. At any point of time, he'll stop the income distribution. Any point of time, it will get revoked. So he still is retaining the control in that trust. That's a grantor trust. So grantor has a revisionary interest. So trust property or income that exceeds 5% of the value of the portion. Revisionary interest is at any point of time he can increase, decrease the percentage. Let's say there are three beneficiaries and he want to add a new beneficiary, or he want to remove some beneficiary. There's always a revisionary interest. It's at the discretion of the grantor. The trustee is not going to take the major decisions when it's a grantor trust. Grantor trust means the contributor is still responsible or still interested. Sorry, not interested. Sorry, guys. Is still responsible and still controlling all the assets. Okay. Now, grantor is the beneficial enjoyment. Grantor retains certain administrative right powers, means whether the trust can dispose the asset, whether the trust can borrow, whether you can add someone in the beneficiary, remove someone. All those major decision, administrative decisions are being taken care by the grantor. Grantor has the power to revoke the trust or return the trust property. Okay, if they want, they can just remove the property from the trust. That's their decision. And grantor has the power also to distribute the income. It's just like, you're saving your property aside in a separate format, and that property is generating revenue. It's totally up to the discretion of the grantor, whether you want to distribute it, whether you don't want to distribute it, whether you are adding some new beneficiary, removing the whole property from the trust. Total control is of the grantor. That's called as a grantor's trust. Okay. Next is a simple trust. Simple trust is like they mandatory have to distribute all income which is generated from the trust to their beneficiaries. And maximum distribution they are allowed to do is fiduciary accounting income. We'll understand this in a few minutes. There is a small calculation sum. Maximum distribution allowed is fiduciary accounting income. And yes, simple trust means they have to distribute all their current income to their beneficiaries. But in complex trust, they don't have to distribute all the income. It's at the discretion of the trustee whether whatever is mentioned, whatever instructions are given in the will, or sorry guys, whatever instructions are given, accordingly he or she is going to distribute the income. Okay, not all income is distributed at one point. One benefit is here you get a standard deduction on your estate tax return. Sorry, on your trust tax return if it's a complex trust up to $100. Okay, we'll see one calculation part for both and you'll understand that. Allocate the tax, allocate tax exempt whatever income is being generated from the simple trust. It's possible there is some exempt income as well. Let's say they are earning some interest income from municipal bond interest. That's considered as an exempt income. So that tax exempt income needs to be allocated separately. So when you are going to do a calculation, you will get to know how the exempt income has been allocated, Rental income expense should be set off from the rental income only, not from any other means. Can I say you cannot take the losses on the rental business anywhere in your simple trust. So maximum up to rental income, you can claim the rental expense while calculating the distributable net income. Okay, we'll talk about it. Here, the good part is you can take a standard whole deduction. Tax exempt deduction is $300 uh, for remaining general expenses. Okay, let's quickly do that one sum, and you'll get an idea of what I was talking about. Let's say the entity or trust is going to pay tax on undistributed income. Okay, this is a simple rule. Whatever entity or trust is not going to distribute the income, they are liable to pay the tax. But the beneficiary will pay the tax on actual distribution, what they are actually receiving. Let's do a simple calculation over here. Let's say there are two beneficiaries. Expense of so okay, there's an income. First, let's understand income. This trust has two beneficiaries, Mr. A, Mr. B. Now, this trust has generated income of from long-term capital gain, from dividend, from rent, and there's also tax exempt income. Okay, but there are some expenses also. The rental property has a rental expense of $5,000. Apart from that, the trustee is managing the whole trust, so the trustee is paying a commission of $3,900. Okay, in this $3,900, there is a bifurcation given that from this $3,900, he is receiving 1,300 towards principal and 2,600 towards income. Means trustee is fully responsible for generating the revenue, managing the assets, paying off the debts, and everything. So his revenue is being classified into two categories. I can say this is his active, whatever active income which he has generated here. For that, he's receiving $2,600, and 1,300 he's receiving just to maintain the assets. Okay, this is how the bifurcation is given: principal and income. Now, first step is you need to check how much is the fiduciary accounting income. Take all your incomes into consideration except long-term capital gain or any capital gain. Exclude your capital gain while calculating the first step. So it will be what? 50,000, 25,000 for rental income, 50 for your dividend, this, and the tax exempt income of 25,000. So total fiduciary accounting income is 100,000. But I need to reduce the expenses as well. Whatever rent expense I have paid, I'll reduce that. Trustee commission, I'll not reduce whole 39. I'll reduce only that which I have received to generate this income, that is $2,600. Okay. So my fiduciary accounting income, my first step is 90 to 400. Remember it in a stepwise format. They'll give you the calculation and they'll just ask you what is fiduciary accounting income, what is DNI, what is distributable net income. They might also ask you what is taxable distribution. They will ask you what's a trust taxable in. So remember each step in a sequential way only. First step, what we did is we just took all the income excluding capital gain, reduce all your expenses. But for trustee commission, only take that expense which is relevant to generation of the income. Don't take the principal. Principal means the corpus. Corpus means the assets of the trust. The asset maintenance related commission, you don't have to take into a reduction in first step. Let's look at the second step. Second step is little bit different. Now from this 90 to 400, how much you are going to distribute, how much is allowed as a distribution. For that, again, you're going to take all your incomes, that's dividend, rental. But now when I talk about the tax exempt income, this $25,000, whatever amount I'm paying, this $3,900 to the trustee commission in proportion to all income, I need to exclude the amount which is relevant to my tax exempt income, because this person should not be paid. Like, I'm not saying should not be paid, you should remember it like this person should not be paid for any tax exempt income, right? So just from $25,000, reduce the proportionate amount of 3,900. Okay, out of that 25,000 is my tax exempt. Out of the total revenue, forget about the capital gain, the total revenue of 100,000, out of that 25,000 was my tax exempt, right? So 3,900 my into 25 by 100,000, that should get reduced. So remaining amount is only allowed for the second calculation. Now here a small twist is there. When you reduce this thing over here, this $3,900 will be allowed as a deduction only and only for your taxable income, that is dividend plus rental. Okay, it's like ultimately you are reducing the whole $3,900. In first step you have reduced only $2,600. Here only the thing is you're proportionating it, you're reducing the proportion of the portion which is applicable to tax exempt income, and in the next step you're reducing from the total, you are just reducing the proportion of trustees commission applicable to the taxable income. So DNI will be 91,100. Okay, so second step will be how much you are going to distribute to the beneficiaries. Now step 3, from this distribution, how much is taxable, how much is considered as a taxable. So the word says taxable, just take the taxable income. What is your taxable income? Forget about capital gain every step, the capital gain will come in the last step. Right now just understand how much is the taxable distribution. Your dividend and your rent income, this two amount are only taxable income, right? So that much, reduce all your expenses. One is the rental expense and second is your commission. Now this you have to take only the commission relevant to the taxable income. So it's just like 3,900 into 75,000 divided by 100,000. Only 2,925 is allowed. So this much you need to reduce, and this is your distribution deduction. So what do you mean by distribution deduction? Whatever the trustee is going to distribute, distributable net income, it is 91,100. Out of that, they are going to get a distribution deduction of only 67,075. Okay, remaining will be considered as a trust taxable income. Again, now you have to take the capital gain. Now you're checking how much tax the trust has to pay, because whatever is been distributed, they don't have to pay the tax on that. Whatever is undistributed, remember the first line, whatever is distributed, the beneficiary will pay the tax. But whatever is not distributed, undistributed entity will have to pay the tax. So take all your taxable income, take your capital gain, take your dividend, take your rent. Your total income is 90,000. Reduce your rental expense. Reduce only the trustee commission relevant to the taxable income. Reduce whatever you have already distributed from step 3. And since this we were looking for a simple trust calculation, $300 exemption will be given. The remaining amount, 14,700, will be considered as a taxable portion for the trust, because this is undistributed amount. Got it, guys? It's a very huge calculation, but in exam will not ask the whole sum. They might ask only certain part, step 1, or only the step 2, or only step 3. What anything they can ask in the exam. So just be prepared. This is the best example I can give for the simple trust. For complex trust is the same thing, only the difference is complex trust is not liable to distribute each and every income. So in exam question, they will give you that, okay, it's a complex trust and they have decided to distribute only 20% of the distributable net income. So first step is going to remain same. Second step is again going to remain same. But third step, you need to decide how much they are distributing and how much is undistributed. On undistributed, income, the trust is going to pay the taxes. Okay. I know this was a little bit a huge explanation. Ideally, I don't give that huge explanation in the summary classes, but that's fine. It was kind of an important. Next is requirement for the tax return. Estate can use the fiscal tax year, but the trust, when you're filing a trust return, you cannot use the fiscal tax year, because the filing deadline is fixed 15th April. And yes, if they want, they can extend it by 5.5 month, extra 5.5 month, means maximum till 30 September you can file your trust tax return. Okay. And yes, trust tax is also liable to pay the estimated taxes, which the deadline is same as an individual's, 15th April, that is 2025, June 24, September 24, Jan 24. Okay. So this estimated taxes, don't worry about the estimated taxes. That will be one separate topic for the whole estimated tax calculation, how much you have to pay and all. The same thing which we are going to do for the individual estimated taxes will also apply for the trust tax return. Yes, they have to pay certain amount in advance in the form of estimated tax. Okay. Next is, yes, AMT calculation, income distribution deduction, everything will apply to the trust tax return. So, like in case of from exam perspective, they're not going to ask everything from every angle for the trust tax return. But just remember, whatever you guys might have learned in individual taxation relating to estimated taxes, relating to AMT, everything will apply to the trust taxes. So let's say trust can also be a partner or can also be a shareholder in some other firm. From there, if they are receiving K1, it has to be reported in the trust return as an income. Okay. Okay, next is the farmer's income. This we are going to take it in the next session. Whatever I have skipped first, let me cover that. Exempt organizations return. Okay. Estate, distributable net income, trust. Okay, now let's come to the 1041. Now we know how the trust tax calculation has been done. There are certain exemptions and deductions that you can take on the 1041 return. So estate is allowed as a $600 as an exemption. Not exempt for dependent. No exemption is available. See, even if the person who died, if that person is going to have might have reported some dependent, the dependent calculation is allowed only till the date of death. After date of death, when you file estate tax return, on that you cannot claim a dependent. Okay. But they are allowed to take an exemption of up to $600 when they file the estate return. Charitable contributions, yes, it is allowed only if it is specified in the will. As I mentioned, it has to be specifically written in the will, plus paid out of the gross estate. So yes, in estate tax return, charitable deduction is allowed as a reduction. Qualified conservation easement grant, it's not allowed as a deduction, but if it's after the date of death and before the estate tax return is been filed, then it is not allowed. Before the date of death is there, then you can claim it on your final tax return. Okay. Easement grant is something like, let's say if the government is going to pay you some grant, or that's considered as your income. So if that is being received after the date of that, let's say 30th June, and before the date when your estate tax return is been filed, so here it is been exempted. Okay. Losses, estate can claim the deduction on sales of property. If you're selling a property, yes, if there can be a capital loss, there can be a capital gain or capital loss, or there is a theft or casualty losses, everything can be claimed either on the final tax return or on the estate. Everything depends on the timing period when the asset has been sold, sorry, when the asset has been, the event is occurring before death or after death. Before death, then you have to consider in 1040 final return. After death, take it in the estate tax return. Same way, casualty losses are allowed depending on the situation when it occurs. Administrative expenses, the small expenses like funeral expenses are there, some medical expenses are there, if you might have incurred, those are allowed on your estate tax return, not on final. See, funeral expense no one will allow anywhere on your 1040, it's allowed only on estate tax return. Okay. Then we have is a depreciation or depletion. So a a portion allowable depreciation and deduction that occurs after the date of death between the estate and beneficiaries based on income and estate is allocable to beneficiaries. It's very simple. If the asset which is being transferred to the beneficiaries, if it was used in business, it can be a schedule C business, it can be any, like it can be their partnership business, C corp business, any business. Okay, I'm just using the word, any business asset is being transferred in estate. So till the date it is transferred to estate, let's say it's transferred on 1st of July, the person died on 30th of June. Before this, yes, depreciation is allowed as in the normal business. After this, the depreciation reporting will be done on the estate, depreciation and depletion. And let's say on 1st December, it got transferred to beneficiary. So beneficiary, if they are going to utilize the asset in the business, then only they can claim the depreciation for the remaining month. Else, if they're utilizing it for personal purpose, they cannot claim a depreciation. Okay, but for estate, yes, for the remaining month, if the business asset is there, right, it's not going to suddenly stop generating the revenue. So on estate return, if you're showing the revenue, you can claim the depreciation on that asset. Okay, that's what this point is mentioning. Next is distribution deduction. Just the last point I'm taking is, yes, so just the last point this I'm taking, and later we'll continue in the next class. It's limited to distributable net income. As I mentioned, one example we saw, right? The second step was distributable net income. Up to that much, you can take a distribution deduction. I think step 3, it was 67,000, right? That much deduction is allowed for the trust, right? Now the trust has to pay the estate tax till what date? 15th April. This can get extended by 5.5 months. Usually our extension time is 6 months in all different types of return, but here for trust it's 5.5 months. So before the due date, you have to pay the estimated tax. Now tax year, either it can be a calendar or a fiscal year. I know in one type of return, it cannot be a fiscal year, that was your trust tax return. But if it's a living trust, it can be a fiscal year. If it's a testamentary trust, it cannot be. Okay, let me repeat that thing which we did just a few minutes ago. It cannot be your fiscal year. Okay. Okay, here in trust topic, we will see that. Yes, trust cannot be a fiscal year, but this has to be the living trust can be of fiscal year, because living trust, the grantor is still, the contributor is still in control of asset, but the testamentary trust cannot have the fiscal year for their filings. Okay, else everyone will start doing the tax planning and save that trust taxes. They will take an extension on estate return, and they'll keep deferring their taxes. So on testamentary trust, just remember, you cannot make as a fiscal year. Okay. So here, estimated taxes before the due date tax year, either a calendar year or fiscal year. If you're using a calendar year or fiscal year, right, then in that situation, what will happen if tax year ends more than 2 years after the date of death? Because if you're using a fiscal year, and let's say the date of death is stick to the same date, 30th June 2024, till next 2 years you are constantly filing your 1041 returns. If yes, we'll follow the individual estimated tax limits. From the third year you will start paying the estimated taxes. If no, so in this like 2 years has not been elapsed, or still you are in the first year from the date of death and second year from the date of death, one time full payment of estimated tax should be done at that point. Single full payment will be done when you're going to file the return. That's it in case of a filing deadlines and the estimated tax. Don't worry about the estimated tax, how it's calculated and everything. There's a different session separately for the estimated tax topic. In part 1, I think I'll take QBI and estimated tax topic together, so you guys will able to understand that. Okay. Distribution to the beneficiaries from the estate, just this last one diagram I'll explain quickly. Beneficiaries of estate that must distribute. Who are the beneficiaries? What kind of trust must distribute? It's the simple trust, right? So distribute all of its income currently, report their shares of distributable net income, whether or not they actually receive it. So if it's a simple trust, the person who is the beneficiary will have to report whole income which is being generated by the trust, whether or not they receive it. Okay. Beneficiary of estate that does not have to distribute all of its currently made income, that's an example of complex trust. So they have to report all income that must be distributed to them, whether or not actually distributed. Okay. Plus, along with that, those beneficiaries will also have to report all other income paid, credited, required to be distributed up to their share of DNI, distributable net income. Okay. So they must report all income that must be distributed to them, whether or not actually distributed. This is like for complex trust, they have to include all income plus their share of DNI. Okay. There is no practical question on this, but just remember this thing on theory perspective. Just write it somewhere here. It's an example of simple trust. It's an example of complex trust. In simple, you're going to report only the share of DNI. Okay. Here in complex trust, you have to report the share of DNI. That is fine. Along with that, you have to report all income. All income that must be distributed but is not distributed. Okay, that's complex trust. In simple, they don't have any option. They have to distribute everything. So they have to just report. The receiver will have to distribute the distributable net income through K1. They will receive a K1 from the trust. Okay. Request for the prompt assessment. Let's say if you're closing your trust, you have distributed all your assets to the beneficiary after 2 years from filing your estate tax return. You have to do a request. So the department will assess your taxes quickly, and they can assess it within 18 months from the date when the return request was received. Okay, so later on, what will happen? Let's say after 3 years, after 4 years, if they send you some notice, no one is available because trust is dissolved. No one is the trustee to whom they will address, right? That's why they will ask that quickly complete your assessment for checking our tax liability within next 18 months from the date of request. Okay, that's a quick assessment, prompt assessment, which you can request if all the assets are been distributed. Okay, so a very quick overview. Let me check. Okay, the exempt organization is just a very small topic. I'll take tomorrow when we start the session. Tomorrow's topic in part 2 will be like, first I'll start with the exempt organization and explain the farming income. Okay, rental property will take it on the last day. It's very small topic, but before that you need to understand the income, expense, partnership, S corp and all. Then later we'll take it on the last session. Okay, any question guys, anything, you can just put it in the chat box. And tomorrow we are meeting at on like at the same time for 3 days. Please bear with the same timing. Later on, let me receive a feedback from the people who are not able to join or at this time. We'll accordingly will just adjust the timings. Okay, so